What if I told you one of the hottest trends in commercial real estate right now isn't fast food, it's drive-through coffee. And not Starbucks, smaller, faster growing brands that most people had never even heard of a few years ago. Because right now, investors all over the country are racing to buy into these drive-through beverage concepts, hoping they're getting into the next major franchise wave before the rest of the market catches up. But here's the problem. When a brand starts growing this fast, it's very easy for excitement to outrun the fundamentals. And that's where investors can make very expensive mistakes. Welcome to the Commercial Real Estate Deal Room. I'm Mercedes Schaffer. I'm a commercial real estate broker and business broker, working with investors nationwide on commercial real estate and business sales and acquisitions. And on this channel, we break down real deals, real numbers, and the real risks most people aren't talking about. Because I don't just look at the lease and the cap rate, I look at the business behind the real estate. Because if the business weakens, eventually the real estate becomes vulnerable too. And today we're diving into a 7 Brew coffee investment opportunity in Decatur, Texas. And honestly, this deal sits right at the center of one of the most fascinating shifts happening in commercial real estate today, the explosion of drive-through beverage concepts. Now, this isn't the biggest deal I've ever covered. It's not a trophy Starbucks. It doesn't have the same institutional reputation as a Chick-fil-A, but that's actually part of what makes it interesting. Because some of the biggest opportunities in commercial real estate happen when investors identify emerging brands before the broader market fully prices them in. But that's also where things can get risky, because rapid growth can create enormous opportunity, but it can also create vulnerabilities that are almost invisible on the surface until it's too late. So in this first video, I want to zoom out before we even get into the underwriting. I want to look at why investors are suddenly so excited about 7 Brew. What's driving the momentum? Whether this brand actually has long-term staying power, and whether some of the enthusiasm may be getting ahead of the fundamentals. All right, let's dive in. So let's start with the obvious question. Why is 7 Brew growing this fast? Because growth at this scale doesn't happen accidentally. The company has reportedly grown more than 4,000% since 2019. That's not a rounding error. That's a brand on an almost vertical trajectory. And Blackstone, one of the most sophisticated institutional investors in the world, has backed it. Franchisees are rushing in. New locations are opening across 38 states. And now commercial real estate investors are buying these properties as long-term passive income assets. So what's actually driving this? Here's the thing. 7 Brew is not trying to compete with Starbucks in the traditional sense. This isn't about people sitting inside on laptops nursing a latte for 2 hours. This is speed. This is convenience. This is energy drinks, flavored beverages, and highly customizable orders. This is younger consumers who want fast, personalized experiences they can share on social media. And the model itself is brilliantly efficient. This building in Decatur is approximately 510 square feet. Let's think about that for a second. 510 square feet. That is an incredibly small footprint compared to almost any other food and beverage concept, but that's entirely intentional. The whole model revolves around throughput. Cars in, drinks out, fast. And from an investor standpoint, that smaller footprint can actually become very attractive because smaller buildings are often significantly cheaper to develop, and they can produce surprisingly strong sales volumes relative to their size when the model is working well. Now compare this to Starbucks. Starbucks is still the dominant force in coffee nationally. It's the legacy giant with decades of brand equity. But Starbucks has also matured. The growth story there is largely written. 7 Brew, by contrast, feels newer, more energetic, more trend-driven. And in many ways, it reminds me of what Dutch Brothers did several years ago, building a near cult-like following among younger consumers who felt like they had discovered something special. And Wall Street notices that. Franchisees notice that, and commercial real estate investors especially notice it when they believe a brand might still be in early innings of a much larger story. Now, let me shift the conversation slightly, because this isn't just about coffee. This is also about investor psychology, and I think this is one of the most important things to understand clearly. Investors are constantly trying to identify where consumer demand is heading before the rest of the market fully catches on. That's true in equities, that's true in business acquisitions, and it's absolutely true in commercial real estate. Because here's what happens as brands mature. Once a concept becomes fully institutionalized, cap rates compress, pricing gets aggressive, and the upside the early investors captured is largely gone. That's what's happened in Starbucks. That's what's happened with Chick-fil-A. And that's what's happened with many of the top-tier drive-thru brands over time. And so investors start searching for the next emerging concept, the brand that's growing fast enough to matter, but still early enough that the pricing hasn't fully caught up with the story yet. And right now, many investors believe 7 Brew may be exactly that brand. Now, whether that ultimately proves correct is something nobody can know with certainty. But this is clearly the thesis that investors are betting on, and I think it's a thesis that deserves serious examination. Because here's the trap. Rapid growth alone does not automatically create a safe investment. In fact, sometimes hypergrowth creates the most dangerous conditions: operational strains, consistency issues, franchisee quality problems as systems scale faster than training can keep up, saturation risk as new locations compete with each other. So while the upside story is absolutely compelling, and it is compelling, sophisticated investors also need to understand what can emerge underneath aggressive expansion, because enthusiasm unchecked by analysis is where investors make their most expensive mistakes. Now, before we get into the specific location, I want to take a step back for a moment and talk about something more fundamental, because I think it's worth addressing directly. We are living in a high inflationary environment, and if your money is sitting in cash, in a savings account, or even in most traditional investments, it is effectively losing purchasing power every single year. Real estate, and specifically income-producing real estate, is one of the most historically effective hedges against inflation that exists. And here's why. Unlike almost every other investment vehicle, real estate allows you to leverage your capital, meaning you can control a $1.38 million asset with significantly less than $1.38 million of your own money. And here's why. Unlike almost every other investment vehicle, real estate allows you to leverage your capital, meaning you can control a $1.38 million asset with significantly less money than $1.38 million of your own money. And the returns, the income, the appreciation, the debt pay down are calculated on the full value of the asset, not just your equity. So let me make that concrete. If this property appreciates 3% per year, which is relatively modest, that's roughly $41,000 of value created in year one. On a down payment of approximately $550,000, that's meaningful outperformance on the capital actually deployed. And when you layer in rent growth, loan pay down, and the compounding effect of all three working simultaneously over 5, 10, 15 years, that's how real estate quietly builds serious wealth, not through overnight wins, through disciplined compounding positioning. Now, I want to really emphasize, triple net real estate investing is not a get-rich-quick vehicle. If that's what you're looking for, this is not the right category for you. But if you're looking to put your capital to work intelligently, protect it against inflation, generate passive income, and build equity over time, this is one of the most powerful tools available to individual investors. And quite honestly, the bigger risk for most people isn't purchasing a sub-optimized property. The bigger risk is not investing at all. Because time is one thing you cannot get back. And every year that capital sits idle is a year of compounding you will never recover. By the way, I do want to mention this quickly. If you're actively evaluating deals like this, or you're in the middle of a 1031 exchange and need help identifying and analyzing the right investment property, my contact information is in the description below. Now, let's take a look at why this specific location caught my attention. Now, let's talk about why this specific site in Decatur, Texas probably made a lot of sense to 7 Brew when they selected it. This property sits within the Dallas-Fort Worth Metroplex, roughly 40 miles from Fort Worth and about 50 miles from downtown Dallas. And the DFW Metroplex is the 4th largest metro area in the entire United States, with over 8.3 million residents. That's not background noise. That's a massive regional economic engine. And what's important to understand about growth corridors like this is that expansion moves outward. As core metro areas densify, population and retail activity push into surrounding suburban and secondary markets. And Decatur appears positioned directly within that outward expansion. The site itself benefits from strong traffic on South FM 51, which carries over 17,000 vehicles per day and sits just off US Highway 287, which sees more than 33,000 vehicles daily. For a drive-through beverage concept, traffic patterns and commuter flow are everything, because this is not a destination product. This is an impulse product, a routine product. People don't plan a trip to get a 7 Brew. They see it, they pull in, it becomes part of their morning routine. And surrounding the site are major national retailers. Walmart Supercenter, which draws over 2.8 million visitors per year, McDonald's, Chick-fil-A, Sonic, and I always pay very close attention to this because national retail spend enormous resources analyzing traffic, demographics, and consumer behavior before selecting locations. When you see multiple strong national operators clustering in one corridor, that is usually not a coincidence. The site is also within a half-mile of the Wise Health System, which has over 275 hospital beds, and McCarroll Middle and Elementary School, which serves over 1,300 students. Those are consistent daily traffic generators, morning, afternoon, and basically all week. Exactly the traffic profile a drive-through beverage brand needs. So is this a good deal? Let me give you my honest read at this point in the series. I understand why investors are excited about this brand. The growth story is genuinely compelling. The drive-through model fits where consumer behavior is heading. The footprint is lean and efficient. The brand feels current, and this particular location appears to be positioned within a strong retail corridor in a genuine growth market. But, and I want to be transparent about this, fast-growing brands also create some of the biggest investment mistakes when investors get emotionally swept up in the momentum and stop asking harder questions. Because the question isn't just, is 7 Brew popular right now? The question is, will 7 Brew still be this relevant in year 7 of a 10-year lease? Will the unit economics hold up as the franchise system scales? Will franchisees remain profitable as competition intensifies? Those are the questions that separate sophisticated investors from excited ones. And in the next video, that's exactly where we're going, because rapid growth can be both the opportunity and the risk. And understanding which one it is for this specific deal is where this analysis gets really interesting. If you're actively evaluating deals like this, or you're in the middle of a 1031 exchange and want help identifying and analyzing the right investment property, my contact information is in the description below, and I'd love to connect. Make sure you subscribe, because in the next video, I'm going to break down the hidden risks behind fast-growing brands like 7 Brew and why explosive growth does not automatically mean a safer investment. Thanks for watching. I'm Mercedes Schaffer. This is the Commercial Real Estate Deal Room. I'll see you in the next deal.